Hi, this is James Shug with Westpac London's end of day report for Friday, July the 5th. Well, the main story in town today was the US jobs report for June. We saw a 195,000 increase in the payroll measure of employment. There are back revisions that added another 70,000 jobs to the April and May figures. So we've got a 196,000 per month average gain through the second quarter. It's a little bit slower than in the previous two quarters, where we saw payrolls average more than 200,000 per month, but certainly stronger than the middle two quarters of 2012, which were running just a 130,000 pace. And of course, it was at that time, following those weaker jobs numbers through the middle of last year, that the Fed embarked on its current open-ended quantitative easing program. So for those that expect the Fed to begin tapering that program, i.e. buying less than 85 billion of treasuries and mortgage-backed securities per month, the data was certainly supportive. They don't sit well though with the economic growth numbers. I mean, the US economy in the latest two quarters we got figures for, that's the fourth quarter of last year and the first quarter of this year. Put that 6 month period together and you get a 1.1% annualised growth pace, and that's down from 2.2% in the previous two quarters, and at the turn of 2011-2012 a 3% annualised growth pace. So the economy has been showing decelerating economic growth since the early part of last year, yet jobs growth has been quite robust. In fact, in the first 6 months of this year, let's see, I've got the numbers here. The employment story in the US saw 201,000 on average. So 201,000 payroll jobs on average between January and June this year. That compares to 185,000 per month in the first 6 months of 2012. So you've got slightly stronger jobs growth in the first half of this year at a time when the economy has been decelerating. Now, a bit of a conundrum there. We do get second quarter GDP growth figures at the end of this month, and they're going to include annual benchmarking revisions and also some tweaks to the methodology. And I'm beginning to wonder if we're going to see potentially an upgrade or upward revisions to the recent growth story in the US, because the jobs numbers and the GDP numbers just don't sit well together as they currently stand. I mean, it may be we see jobs slump in the next quarter, but something's got to give, basically. So either growth gets revised up or jobs fall away again. In Canada, we saw essentially flat jobs in June after a very strong 95,000 increase in May. As in the US, where the unemployment rate was steady at 7.6% because of increased participation in the labour market, in Canada the unemployment rate was steady at 7.1%. German factory orders, they were down 1.3% in May after a 2.3% fall in April, the first back-to-back monthly declines since the third quarter of last year. Annual growth in orders is down 2%. So a bit of a weaker industrial story starting to come through in Germany again, after some hopes that the slump in activity at the end of last year might be temporary. We've got Greece and Portugal rattling on. It looks like Portugal's managed to hold its government together, and the Greeks have apparently identified 12,500 workers to be part of this mobility program, which basically means they lose their jobs, but necessary if the latest bailout tranches be paid. So European sort of periphery issues are kind of coming a little bit under control, it seems. And that's about it really for today. US markets were closed yesterday, so they didn't participate in the big rally we saw in European stock markets following the Bank of England and European Central Bank's low rates guidance, which is why today the Dow is pretty much unchanged, up 0.06%, heading into the New York lunchtime at 14,997, in contrast to quite steep losses in European markets, with the London market just ahead of the close down 0.5%, the French market down 0.8%, Germany's down almost 2%, and there's 1% plus losses in Spain and Italy. And the reason for that is that the strong jobs numbers in the US basically add to the case for the Fed to begin unwinding its accommodative policy stance, and that's seen equities sold off. They didn't sell off in the US because they didn't rally yesterday because they were closed. In commodity markets, we've seen sell-off in copper and gold down 4% and 3% respectively. The gold price is $1,214 an ounce, but oil prices are higher, up 1.2% and $102.47 a barrel. The Aussie dollar took a hit as soon as those jobs figures came out, fell from, let's have a look, just under 92 cents really, to 90.7 at the moment. So more than a 1 cent decline in the Aussie dollar after those strong jobs numbers came out. Look, it's going to be a beautiful weekend here in London. Actually my last full week in London for a while. So I'm going to leave it there. I'll be back next week and I'll speak to you then.